Setting you up for the trading week where Wall Street will be shifting their focus from corporate earnings to economic data. We have manufacturing and services sectors pointing to an expansion for the month of July. As for NFP, the U.S. economy is estimated to have added force this upward trend, but someone who is bucking the trend in terms of that sentiment is Todd Horwitz. He's chief strategist at BubbaTrading.com. He joins us live from Chicago. Good afternoon to you, Todd. Great to see you. Now, we saw the S&P 500 hit that high on Friday, yet you say your best investment strategy is to short the markets. Why, if we see these rallies continuing?
Good morning, Pauline. Let me tell you it like this. We've got a market that is being built on artificial dollars, that is not really being built by true price discovery, where the markets are actually pricing asset classes. So we've got markets making a high, which is great, but those are the big markets. And the big markets, the S&P, the Dow, the Russell, and the Nasdaq, I think are tremendous shorts up here. It doesn't mean that I wouldn't look at some individual stocks to potentially buy. But overall, I think I would have to put my bearish sentiment at maybe one of the highest of my all-time career as being a bear. And, you know, I just can't see how we can continue to push it up on artificial money when you're forcing every investor into the stock market and no place else. You know, when negative yields around the globe and very low yields here in the States, there's no lending rate. Where are you going to go to put your money? You're forced in the United States stock market, which eventually the buyers will run out and the markets will fall. And we're seeing no CapEx spending, which your earlier guest said. We're seeing a lot of things that don't make sense to the overall economy. And the bottom line is no growth and lousy jobs.
Yeah, indeed. Consumers are spending, yet businesses are not spending, and they're not spending on equipment either. In terms of a pullback, so you're saying get ready for a pullback. How big would that pullback be, and when do you anticipate this happening?
Well, I think the pullback here, I see about 20 or 25% if it starts sooner than later. I believe that as long as the Federal Reserve continues to put a floor under the market, as long as this continues, the sell-off will be much bigger. I think it's much better to take the beating that we're going to eventually take and weed out the weak, and it will be 20 to 25%. If they continue to prop up this market, eventually it will be bigger. But it's going to be ugly, and deservedly so. I mean, we're 8 years, $4 trillion into a market that has seen zero growth when you really look at the big picture. There has been not any company spending and a lot of cut down on jobs, with a jobs rate that is the lowest participation since 1973.
Todd, I know you have been very critical of the Fed, and you don't expect them to hike anytime soon. You think they should have done it a long time ago. Let's take a look at some of the data they have to digest, because we saw Q2 GDP coming out much lower than expected at 1.2%. Also, Q1 GDP was revised down to 0.8%. I mean, even if the jobs numbers are good this Friday and the next jobs report, the Fed could surprise. I mean, would you be pleasantly surprised if they decided to do something in September or, say, December?
I would love them to do something, but I would say, in my estimation, that we're looking at mid-2017 before they'll do anything. They don't have the courage or the guts to raise rates. And the damage that they're doing, think about it this way, Pauline, they're destroying the profit, the bank's ability to lend money out. They're hurting insurance companies. All the financial industry, as you can see by the way their stocks have been acting, have not been doing well because they've lost their ability to invest that money and keep turning it over. But I don't see the Fed raising rates until mid-2017. In fact, I wouldn't be surprised if it was until 2018, because they're too comfortable with the dovish sentiment that Janet Yellen has brought, even more than Ben Bernanke.
In terms of specific investment picks, you've always been big on commodities. I see that. But in terms of specific companies, we've seen some pretty good earnings, even though your argument is that expectations have been set so low. But let's take a look at Facebook, Alphabet, Amazon. Any of those ring true to you as great investments?
I think that, well, first of all, I think Facebook will be the first $1 trillion company. I think it's a great company, but I can't really chase it up here and buy it at an all-time high. I think anywhere of a pullback, Facebook's a great play. I loved Apple last week before earnings in the mid-90s. I thought that was a great play. You know, Alphabet, a little pricey. I think we really need a little bit of a pullback. We'll have an opportunity. You know, markets will always correct eventually. And I don't think you have to come in here and chase the market now. If you're an investor and you're in the market, I wouldn't sell. And I'm still personally, I own the market. I'm short trading. I'm an investor that I own, but in the short term, I trade. And I'm trading from way the short side right now, and I hedge my overall portfolio. But a lot of these stocks are just so pricey here that the market figures are correct. But Facebook's a great company. Google's a great company. Amazon, really surprising now. Their PE ratio is coming way down. So they're looking to be better. But up at these levels, I think it's kind of hard to step into this nosebleed territory.
Okay, quick disclosures from all those companies.
In all those companies, I do own Apple, and I am short Facebook right now.
All right, Todd, great talking to you as always. Todd Horwitz from BubbaTrading.com, joining us from his office in Chicago there. Now, on